Okay, welcome back, everybody. We will have some stuff from last time to go over. We had about, I think, 10, 20 slides left last time because we got into a nice discussion in the middle, which, by the way, I want to encourage. So please, if you have questions, don't hesitate to ask them. To me, like, we get a lot of our best learning moments out of questions because it dives into the specifics of what actually impacts you at home. So please, feel free to continue asking as many questions as you got, but let's get forward a bit and see where we left off all the way through. Somewhere around, yeah, okay, all right. Okay, so we have a couple different things in here. I'll start here at this sort of stairway of tax efficient saving and investing that we like to look at every once in a while. This is just kind of, it's a cool thing to look at if your only concerns really were tax efficient investing and how you might start with that and just create a really tax efficient plan starting from the bottom up. So this is great for people who are accumulating, who really hate paying taxes. So if you know anybody like that, it's great for them. But we like to start with something like a tax-favored money market fund. So money market funds, as you know, are super low volatility. Usually they go up and down by 1% ever. Sometimes they drop by 2%, and then that's when things get really squirrely. But for the most part, these are what we consider a cash equivalent. So it's basically the same as just having cash in your account, but they earn better interest rates when interest rates are doing better in the marketplace. And so if we move up, then we've got some tax-favored index or ETF income funds. So things like, you can think municipal income or municipal ETFs, municipal bond index funds, stuff like that, that pays income with preferential tax rates, sometimes tax-free rates, depending on what kind of municipal bond ETF we're looking at. Moving up, we can think of tax-managed growth fund, index, or ETF funds. So we'll talk about the differences between mutual funds and ETFs in a second. So don't worry too much about the technicalities there. But when we're looking at growth assets in general, what they don't tend to do is shoot off income, because for the most part, a growth asset is considered something where we're looking for the market share to increase, not necessarily their profitability. So it could be a company that hasn't reached profitability yet. It could be a company that simply does not share that income with their shareholders and reinvests into the growth of the business. But for the most part, we're thinking a tech stock is usually a growth security because a lot of the times they're not profitable and they invest a lot of money to scale. So for an investment that doesn't shoot off a lot of income, the reason that that's tax efficient is because it doesn't generate any current tax liability as you hold it. You can hold on to a growth ETF, and if it doesn't shoot out any dividends to you, there's nothing for you to get taxed on until you sell that asset. Moving up from that, we've got our tax-deductible retirement accounts, which are things like, you know, your IRAs and 401ks and stuff like that, where you might get a current tax deduction for putting the money in there. That's always great. And then you defer the taxes on the earnings until you take it out of the account. Moving up again, you have something like a personal residence, because when you acquire a personal residence, particularly with a mortgage, the interest on the first $750,000 of mortgage that is used to purchase the home can be written off. I'm sure a lot of you have done that over the years. It's a very common tax deduction that people can get, and a way that you can break free of the standard deduction. Looking at stuff like a Roth IRA, Roth 401k. So Roth accounts aren't currently helpful in our tax situation because we put after-tax dollars in there, but they have really, really strong compounding effects on the back end. So if we're looking at somebody who's either younger, or if you're planning to leave an account to a beneficiary, just sort of longer term planning than the next 5, 10 years, you can get you can put a lot of riskier assets in there, get a lot of growth, and when the assets come out of that Roth account, they come out completely tax-free. So almost no matter what your tax rate is, if you've got a lot of my laptop is restarting. All right, that's great. well, anyway.
Just tell us that.
Yeah, I know we got a couple more things in there. But yeah, so with those Roth accounts, we really like that long-term benefit because we get to get that back end. You want to help me out on that one? I don't think I've heard of a Roth TSA.
Tax sheltered annuity 403. Some of the school districts, they.
That was really, so over 3 I didn't know it was a TSA.
Yes, yeah,
I have a 403B. What is it? Yes.
tax sheltered annuity. That's where the salespeople just come out to your school and say, hey, have I got a deal for you? The IRS code is a 403B. That thing's in the book if you want that
Yeah,
stuff.
okay.
And so when, yeah, nonprofit, so they said, hey, we need to get up to speed, we need to do a Roth. So, people could do the 403B TSA Roth instead of the 403B TSA tax deductible contribution. Yeah, so you can do.
I didn't know I ever had that.
Yeah, well, even, a lot of places, let's say private employers don't even have Roth 401ks because they didn't want to spend the money or get up to speed. So usually the state and everybody else is pretty good shape. But yeah, all those things.
Okay, well, while we're waiting for this to come back, I guess I can talk to you a little bit about the two handouts that we gave out just now, and I can jump ahead to a conversation that we'll be having later in the slide deck. But you got some handouts on comparisons between mutual funds and ETFs. I know I've had a couple people ask about what ETF stands for. So mutual funds and ETFs are two incredibly similar products. They are essentially a way to wrap up a whole bunch of individual securities into one purchasable product that an investor can buy one time. So if I want to buy all the stocks in the S&P 500, I could go do that myself, and it would be very painstaking. Depending on the broker I'm with, I might have commissions on every single one of those purchases. And I might get that allocation once, and then something changes, and I got to pay attention and change my portfolio along with that, or make sure that I pay attention to the weightings inside of that portfolio. But with something like a mutual fund, you have a company that takes care of all of that for you. So if we're going to mimic the S&P 500, they will look at that list regularly, look at the weightings, and make sure that everything that they have proportionally represents that. And so then you just go to the mutual fund company and go, I want a slice of that pie. You buy some shares from the mutual fund, and it represents ownership in that entire basket of securities. So the way that mutual funds and ETFs are a little bit different is you can think of mutual funds as more like it's a little bit more of a direct participation from the shareholder in sort of a perspective. So when you have a mutual fund, you don't purchase shares from other shareholders, you purchase shares directly from the mutual fund itself. If you were going to buy shares of a stock from some sort of company, for the most part, unless you're participating in the IPO, the initial public offering of those shares, you're going to be buying your shares from somebody else on Wall Street, not from the company directly. And there's not going to be a new share issued every time somebody buys it, because they would dilute. But with a mutual fund, you're dealing directly with that fund company pretty much every time. It might be through your brokerage account, it might be through an advisor, however that works, but you're going to be giving your capital directly to that mutual fund so that it then goes into the pot of securities that are managed. And so what this means is you don't have to buy whole shares, which can be kind of useful if you have a very specific dollar amount you want to invest. If you've got around $1,000 and I'm looking at a share of a company versus a share of a mutual fund, I can give the mutual fund my round $1,000 and they'll give me an exact amount of shares to the decimal point that represents my $1,000. Versus if I go somewhere else to buy a stock or an ETF, I have to buy round shares. I have to buy a whole share. So I might only be able to buy shares that get me to $9.93 and change, or I might have to spend a little bit more than that 1,000 in order to get a round number of shares. So that's one of the differences there. Sure.
So back here, it says active and index varieties. Are ETFs also active and index?
Yeah, so the strategies between the two products, they used to be that ETFs were mostly index products. They mostly just followed some other basket. But over time, and especially within the last couple of years, a lot more active strategies have come about. So just a quick reminder, active strategies are where the managers are making their own decisions for what gets included in a fund in the strategy, versus an index is they go, I follow that already predetermined index and I just provide this for the customers, just kind of as a middleman to make sure that you actually get access to that. So an index is like, okay, so an index is like, it's like a sector. It's basically just a list. So if you've got all these companies on the stock exchange, I can make a list that includes a certain number of those securities. So we've got, it was like or $5,000 or 4 or 5,000 stocks to choose from, but I want the 500 biggest. And that index is called the S&P 500 because it basically, yes. And so there are a lot of different indexes, but for the most part, we think of sort of those big three, which is the S&P, the Nasdaq. That's not what I wanted to open, and the Dow Jones.
Certain publishers create different indexes. So in this room, if we said, let's create the baby boomer index, then we go out and say, what's the top 100 companies that we buy from and we use, or we buy their stocks, and we all get together and say, okay, this is the baby boomer index. And if all of a sudden people write about us and say, oh my gosh, I want to buy those stocks that the baby boomers are buying, then Vanguard, Fidelity, Schwab, iShares contact us saying, can we use your index? We'll start a fund saying we'll buy the same stocks and we'll charge a tiny fee, the Vanguard fee blows, but we can publish it and we came up with an index and that's what we do. So there are thousands of indexes published by S&P 500, S&P Standard & Poor's, and State Street and all these other companies. So there's thousands of indexes. We just hear about a few of them.
In other words, thousands of categories or
Yeah.
a bunch of groups.
Yeah.
Groups of.
Yes, exactly.
If we had the rights to the Dow Jones or the baby boomer index, all these companies would pay us a fee each month to subscribe to them saying, we have a baby boomer index with Vanguard. Fidelity has a baby boomer index and they track this index and they pay us a fee to be able to use them. Because you'll see an S&P 500 fund with all kinds of companies, they all have to pay and it reports a fee to that index. And the people creating the index have to rebalance it ever so slightly and then tell them you need to buy this or that because our index is a little out of whack.
So are there new indexes created all the time?
Yes, absolutely. Yes. Yeah, and if I could use your index and I go start a fund, then I'm gonna get a tiny fee and then you can buy it and I get the name.
Yeah, so basically you can kind of think of it as like the researchers and the analysts come up with the indexes and they go, this index represents this, and I'm determining that it's a good representation. So you'll have something like a utilities index where a researcher will go, I think this list of companies most well represents the utilities sector. And so then a bunch of other fund companies will go, oh, okay, well, I want to make a fund that represents the utilities. And since the research shows that this index represents that sector best, I'm going to use that sector as my reference point to build my index fund, and then that will be a product that's available to the investors. Okay.
Thank you very much. That's probably really big.
Yeah. Yeah, and we will get to. I've got some more slides later that will get into more detail about those later, but. Let's get through some more of these from last time. So, okay, all right, we were at step 6, now moving up to step 7, tax-deferred annuities. Pretty much, for the most part, a lot of these annuities, so a lot of variable annuities, when you put your contributions in, it's kind of like almost a Roth or almost a traditional retirement account, but not quite either of those, because the only thing that gets deferred is the earnings, and then eventually when you take the money out, it's taxable again. So you put in your your already taxed income to purchase the premiums for the insurance on the annuity, and then you'll also have some money that grows within it and the interest that they credit you or whatever sort of annuity you've got. And those earnings can be deferred. So they'll just accrue within the policy, and because they're not quite yours yet, you don't get taxed on it until they come out of that policy. So usually with annuities, we don't like them as a replacement for a retirement account or a replacement or for a brokerage account, but it's like if you're looking for, if all of your other tax advantage assets are completely exhausted and you've got no other way to get benefits, an annuity can be an additional product on top of that. So usually annuities they're better for high income earners for the most part. It's like once you've done your whole 401k, you've done your whole Roth IRA, all your steps you've done everything, your HSAs, you've gotten through all that. Most of us don't reach that and then still have more to go. But then if you do, an annuity can be an additional product that you can use to get a little bit of tax deferred growth. So yes.
So it says tax deferred. When do you actually start getting taxed When do you start paying taxes on an annuity?
So you'll pay taxes when you do a couple things. You might surrender your contract, which means you're basically just, if there's a penalty, you pay the penalty and then you're taking the full amount out of there. Or if you annuitize, it'll split parts of those annuity payments between the principal that you put in versus the earnings that you got. So some of it will come back to you tax-free because it was just principal like any other investment. And then you'll get a portion of that taxable, which represents the earnings that you got when you stayed in the policy. So after this, we have things like commercial real estate, where if you're active in commercial real estate, there's a lot of tax deductions that you can get for that business specifically. And then obviously something like a personal business where, as you know, Schedule C deductions can be very powerful. If you're running your own business, you can write off a lot of expenses over time. So it's not really a thing where, it's like it can be a very high risk investment, or it can be a very low risk investment depending on where you are in the business cycle, but it's something that we like to add on there on the top anyway. So another conversation that we can have is when we're talking about Roth conversions. So converting an IRA, or converting your IRA or part of your IRA to a Roth IRA can be beneficial for a couple reasons, but it can also just be kind of overrated in some other situations. A lot of people like to rush to get them done, especially if they haven't done them earlier in life. And once you get to certain stages of life, they start to become a little bit less beneficial unless we have a particular use case for it. So let's talk about some of the characteristics of doing a Roth conversion. So if we're looking at reasons for converting to a Roth IRA from your current traditional IRA or rollover IRA, you might be retired and are in a lower tax bracket. So the reason that you might want to use this conversion is because now you're in a lower tax bracket and now you can pay less taxes than you would have before at your higher income. And then you can possibly use some of that time for growth. So if you've got extra time that you can grow the assets and get those earnings tax-free, that's pretty fantastic. If you retired later in the year and you can defer some of your current income to the next year, or some of your compensation or pension or whatnot, if you can defer it to the next year instead and now have a little bit of gap where your income is lower because you retired and you're not getting paid for the last portion of the year, and you can defer that income to the next one, now your income should drop a bit, your taxes might be lower, and you can fill up basically what you would have been paid with a Roth conversion. So you would have effectively sort of the same tax situation, but now you're able to move money over from an IRA to a Roth IRA and give that time to get those tax-free earnings. And then another one, and this is kind of this is really usually the only amazing reason to do this in late stage of life, is if you want to pay the conversion taxes for the benefit of your future beneficiaries. So if you want to leave your IRA to somebody, but you don't want them to have to worry about taxes, and you just want to go, I'm going to pay this bill today, and then we're going to let it grow as much as it can. Then when they receive it, tax-free money, it doesn't add to their tax bill, it doesn't do really anything but just give them the capital. That might be a reason to do it. Mathematically, it may or may not work out, because if they're in a lower tax bracket than you are, then it would be more beneficial for them to pay the taxes, depending on how much time we have for it to grow. But really, we like to kind of look at the strategy as just a gift and be like, I'm going to pay this tax bill for you. That way, when you get these assets, totally tax-free, don't worry about it. And then the last one would be if your future income is actually going to go up. So if your marginal tax rate is going to increase, then you want to get the Roth conversions out of the way. And then that would be getting that into that Roth account so that later, when you take the capital out, instead of taking it from a traditional IRA and paying taxes at a higher rate, then you'll take it out of the Roth IRA and pay nothing, which is pretty fantastic. So a couple reasons why you would not want to convert to a Roth IRA would be that if the tax liability moves you up to a much higher tax bracket. Obviously, if you're jumping tax brackets, now all this money doesn't get charged at your current rate, but it gets charged at the next one. And that's not really helpful for anybody, because you might not have enough time for the growth to outweigh those taxes. If you don't have the money for taxes set aside is also really important, because you don't get to take a little part of this and pay the taxes with it. It has to go straight from the IRA to the Roth IRA. You need to pay those taxes out of pocket. So if you're not ready to pay that out of pocket, you don't want to do the conversion because you're going to have a tax bill you can't afford. If your tax rates are not less than they were when you contributed to your plan, that would be another reason. So if we're at a situation where if your tax rates are similar to when you contributed, or if they're higher, you're not going to get a real benefit from converting to a Roth IRA. You're just going to pay taxes like you would if you were taking the money out. So we don't really want to just pay a lot of taxes for no reason. Again, the best situation for this is when we've got a lot of time for the earnings to accrue, or if you're able to pay the taxes at a lower rate for somebody that's going to receive them at a higher rate. You have a question?
You're gonna take the money out in 5 years. It seems like if you put it into the Roth, then in 5 years you won't have to pay it. I guess that's the same thing you're saying in the future.
Yeah, so it's like 5 years is a tough time frame because it's just long enough to where if everything goes smoothly, the earnings might actually outweigh the taxes. But you have a really high chance of maybe having a good time and then stock market crashes, and then the loss in principal or the small amount of growth doesn't offset the taxes that you would have paid in the first place. So it just kind of becomes a moot point. So it's one of those things where it really is best when you've got a nice long stretch of time. Like if we're talking 10 years plus, that's where it makes a way more sense to do a Roth conversion. Otherwise, it's just kind of like creating a new tax situation when you don't really need to.
You mentioned timing with Medicare.
Oh, yeah, that's true. Also, another reason why you might not want to do a conversion to a Roth IRA, or depending on your time frame, is if you are paying Medicare, if you're paying for Medicare, your amount of income determines what your Medicare premiums are. So if our income jumps to another level, there's like this sort of lower level that a lot of people, I forget what the exact numbers are, but if you push beyond a certain level of income for Medicare, they'll add another $150 a month to your premium. So you want to make sure that if you're doing a Roth conversion, you're not putting yourself in the next area where you move it over and now suddenly you've got this tax bill that is $150 a month for the rest of the year, or 2 years, because what they'll do is your premiums are determined by looking back on your income within a certain period of time. And if your income within that pool of time is ever higher than their threshold amount, they'll increase the premiums. So that's another reason to be very cognizant of doing conversions, because you might increase your Medicare bill. For some people, that's not really that much of a problem, but for some people, it could be a bit of a stretch in terms of their cash flow planning. So it's really important to.
Or maybe time to do it early before.
Yeah. Yeah. So you could also consider doing the conversion before the 2-year look back. So before you turn 63, do as many Roth conversions as you want, then it won't affect Medicare following that.
Strategy that they take the high rate on their taxes, and then wait 6 months later to roll back into the Roth. Take the tax time to build up the Roth.
I don't think. Oh, we're just talking about a backdoor Roth. Okay. Yeah. Yeah. I would need to refresh on it. Go for it.
So if, I do that every year. I put money in a 401k, but I don't put it in a deductible IRA. I don't have a deductible IRA. And if you don't have any other deductible IRAs or rollover IRAs, you can contribute to a non-deductible IRA, $8,000 this year, wait a day or 30 days, and then convert that to a Roth IRA. Because my income, I'm not allowed to do a Roth. But so the backdoor Roth, or if you have a big money at, this is the mega Roth conversion.
Oh, yeah.
At a 401k,
Yeah.
tax money, you could convert that into a Roth as well. But the backdoor Roth normally allows people who make too much to do a deductible IRA. You can do a non-deductible IRA and convert that to a Roth right after that. And that's a way to qualify to be able to do a Roth when normally you're discriminating against them.
That's why you're still working.
Correct.
Yeah. Yeah, a lot of these things with IRAs and Roth IRAs, like you still have to have earnings for a lot of things. So, um, you know, so then moving on to some real estate tax deductions that we can take with our personal residence. I'm sure you're familiar with a lot of these. Loan points on the first mortgage, mortgage interest for most homeowners on the first $750,000, which is what I was talking about, and that's $750,000 of acquisition. You can't do like pull money out of your house to do improvements and renovations and then deduct that interest. It has to be on acquisition cost. So for the first $750,000 of a mortgage of acquisition cost, you can deduct the interest on that. And then there's also a little bit of property taxes that are deductible within certain limits, which would be the SALT tax. So in California, that's up to $10,000 of state and local taxes. Improvements can increase your basis, which essentially what that means is when you are spending money to improve your house and it is actually going to effectively increase the value of your home, you can add the money that you spent to your cost of acquisition and you won't get taxed on that little bit of money when you go to sell. Yes. Right. So as long as it's something that's actually going to increase the value of the home, that's really kind of what we're looking for. So repairs and stuff aren't going to count. So even though technically you got a damaged roof that reduces the value, you repair it, theoretically it brings it back up, that's not going to count as an improvement. So yeah, we're just looking for things that are driving the value up. Yes. Yes, right? You do have to itemize for improvements. No. That's not something you have to itemize for, I don't think.
Are you just raising the cost basis or?
Just raising the cost basis.
Yeah, no, you just say those receipts, then when you sell the house, then if you need those to offset any tax.
Oh, okay, that's only when you sell it now.
Yeah.
Right, you're not taking a deduction.
What you pay plus improvements, plus 250,000 per person. So if you have $1 million house to be paid $150,000 for it, you would want to save all those receipts, build that cost basis plus 250 per person of exclusion.
You have to itemize each of those receipts when you come them together.
I'm gonna think, at the time of sale, you probably would itemize there because you have capital gains.
Well, we're talking about, it's not a question of itemizing on taxes. This is different. So she's asking about if you need to specifically like line item every single receipt so that instead of just like kind of collecting them together, right?
Right, or you can take a chance, but yeah, we're supposed to keep the receipts.
Yeah, there's another reason we really like software like Quicken, which helps you sort of keep track of all these things. So you can, if you have a receipt, you can put that in there. So I just started using Quicken. One of my clients really likes Quicken. She has some real estate stuff. So you can add in your improvements into there and it'll increase the basis of your real estate within that. And then you're able to generate a report that proves basically what you listed as your cost basis. But it's
Well, that with your taxes, or you just have it as that.
you would basically just have it as justification. I'm pretty sure. Yeah.
When you sell the house.
Yeah.
And if there's capital gains, then you can come.
Well, but yeah, that's what I mean. You would have to put them in your, or just keep them in the background because you're all.
I guess if you keep it in the background and then if you sell your house and if there's enough gain, you want to increase your cost basis and you tell the account, look, I have all these receipts. Add them up and then if you pay 200, but you have receipts for another 50 or 100,000, then you just have them in case you're audited. You tell the accountant.
Yeah, you pretty much just hold on to them in case somebody asks questions. You go, I've got all my receipts right here, because you'll just submit a certain number for your cost basis.
Right, because I am going to sell my house and say this is happening for me, and bring it up to class too, so, I do want to follow up on that. So, let's say you have gains for
Mhm.
now, if you buy another home, which is planning to, so if you roll that over, if the cost of the next home does it roll over, like?
With personal residence, there's no like rollover or like just scooting stuff over. Yeah, no. With personal, this section 121, the 250 that you're talking about, that's the best tax break you get.
Plus the improvements.
Plus the improvements.
So there might be another 50 or 100 or whatever property is should.
Yes, exactly. Yeah. Right, exactly. Yeah, so what you're describing is for rental real estate, which I'll talk about in the next slide. We'll get into that. It's called a 1031 exchange. So I'll talk about that and I'll detail that in just a second.
Okay, and I have one more question about the, and about selling houses.
Mhm.
Because I'm for right now, but, I do believe that for those of us over 55, you can carry your property taxes on 2 additional.
Yeah, I believe something like
I
that.
don't
Right?
know
Is
that
that
it's, minimum of 2, I think it's wherever you move in the state.
Yeah, I think that's 2 options to carry the property.
Okay, yeah, we have to live there 2 of the last 5 years.
yeah, so
Yes.
same test as the section 121
Yeah,
then,
that's
yeah.
good news. We didn't have that before. You had to find a friendly county that would help you keep the same tax base that needed your business. But now the governor said the whole state, you can transfer your house and keep the same amount of value transferred. Now, if you bought a more expensive house, then you have to pay higher taxes on that, increase that.
Yeah. So one thing that we just kind of briefly touched on a couple times was what we just talked about was the $250,000 number, which is the section 121 capital gain exclusion. So if you both own your home and you've lived in your home for 2 of the last 5 years, you qualify to exclude $250,000 of capital gains from that sale. And if you're married, you get to exclude $500,000, which is pretty great. So you purchase a house basically for $250,000 and it goes up in value to $500,000. Now, if you've lived there for 2 of the last 5 years and you own the house and you go to sell it, you don't have to pay any taxes because that $250,000 is excluded. That make sense?
Whenever you sell a house.
Whenever you want, as long as you own the house and you live in it for 2 of the last 5 years. So you could live in it for 2 years. If it goes up by $250,000, cash in, move to the next one, and just do it over and over and over again. Yeah.
Well, onto that, in fact,
I don't remember if there's a form. I don't think so, but I-
My property, I'm qualified for the exclusion.
right. Yeah. Yeah. And it's super common. Like this is all the, nah. Yeah, no, this is super common, something that people have been doing for a long time. And then the last thing, this isn't really like a deduction, but a step up in basis after death is really useful. So if you've got a personal residence that has appreciated a lot in value, if you use something like a transfer on death designation or you leave it to somebody, when that asset passes, just like stocks and just like a lot of other assets, the basis of that property will jump up to the fair market value. So if you bought the house for $250,000, goes up to $1 million, you die and pass it to a beneficiary, their cost basis will jump up to $1 million. Then if they sell it for $800,000, they don't get anything. They sell it for $1.2 million, they only have to pay taxes on the 2, right? So. And then next thing will be for rental properties. So there's a couple different ways that rental real estate can be deducted. If it's a passive investment by you, it will be some of these things here. So you've got loan points at purchase only for the life of the loan, your mortgage interest, again, property taxes, insurance premiums, management expenses, just basically the stuff to actually keep it going and make sure that it continues to generate the rental income, sort of similar to some business deductions. Then we get to the 1031 exchange that we talked about for a moment here. So when it comes to rental real estate, we get this wonderful, wonderful section or IRS code 1031 that gives us what's called the 1031 exchange, which basically means that if I'm going to go sell a piece of rental real estate and I want to go ahead and buy another piece of rental real estate, I get to recognize 0 gain on the transaction and carry over all of the tax consequences, my basis that I had, and I get to hold on to that gain and basically just, instead of selling it and realizing, I get to sell it and pick up all those numbers and just walk them on over to a different piece of real estate and set them down within that. So if I sell a piece of rental real estate, then I go to buy another piece of rental real estate, as long as I'm going to go straight into that other piece of real estate and I have determined which one it is within a timely manner. There's some specific time requirements and some specific administrative requirements. As long as I fulfill all of those, I can go straight from my one piece of real estate in there, pay no taxes, and now have this more valuable piece of real estate. So I buy a piece of real estate for $250,000, it goes up to $500,000, and I say, I'm going to go buy this $500,000 property over here. Great. Sell, buy. This one goes up to $1 million, same thing. I want to buy that $1 million property or $1.5 million or whatever it is, and then I take this money and I just move it to the new property. So that's why a lot of people really like rental real estate, is because you essentially get to continuously move places. So if you find new locations that are better, or you just want to move around in your rentals, you get to defer all of these gains all the way up into the last property where you eventually sell and just pocket the money. So you could walk your way all the way from a couple $100,000 to millions or tens of millions of dollars and not have paid capital gain taxes all the way until that last time, where you're going to have this giant tax bill on all of these gains that you made from that very first property. Yes. Yeah, so that would be the cost basis that you started with. And there are some things that you could do to be adding your cost basis to that over time, like just different costs. But you will, because you didn't recognize the gain, you don't get to pretend that that's part of your basis now. Like that stays as gain all the way through to the end. Yeah. I would recommend it. Yeah. Yeah. Yes.
Use an intermediary rollover type 1031 company. They get the money from the sale. They don't give it to you, and then they send it to the new property that we purchased. So you want yeah, and we almost lost that a couple of years ago. They tried to legislate it out. Could you explain stepped up basis? I don't quite understand this, but we have a client that inherited family money. And so you're going to call the accountant and explain to the accountant, there's two different cost bases here, and explain how that works.
Okay, so what he's referring to is something called the alternate valuation date. So when you die, for the most part, what you're going to use as the stepped up basis is the fair market value at the date of death. However, there is another date that you're allowed to use. The 6-month period, for 6 months afterwards, you can choose another valuation. So you can choose a valuation that is 6 months later. So if I die with assets worth $1 million and 6 months later they're worth $1.5 million, I could choose that $1.5 million instead. I get the opportunity to choose that and also have that next $500,000 stepped up. So if I die with assets that depreciate, then I wouldn't want to do that, because I would want to use the fair market value. If I die at $1 million and then they go down to $500,000, I would rather use the $1 million basis instead, because then if it crawls back up all the way back to $1.5 million, instead of using the $500,000 and having $1 million in gain, I would use the $1 million and have $500,000 in gain. So it's basically just an opportunity to choose another valuation if it goes up in value. Yes. It can. It doesn't often, especially for a very diversified estate, a lot of real estate and personal assets, but just imagine for a second that it was NVIDIA stock, right? Like if you left a whole bunch of NVIDIA stock and then it just flew higher like it did in a very short period of time, you would go, I would definitely want to use the alternate valuation date. Right. Yeah. Now, one thing that is also really important to understand is if you use the alternate valuation date, you don't get to pick and choose which assets it's for. It's for everything or for nothing. So you don't get to go, well, this asset went up by $1 million, but this one went down, so I'm just going to use the alternate. No, 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 no. You pick the alternate valuation date for everything, or you don't, which is why it's very important to understand looking at all of the assets, because for one, it might look amazing. This one might have gone up by 300%, but the rest of the assets that were a way bigger portion of the estate might have dropped by a significant amount, completely outweighing that gain. So it's important to look at the whole of the situation and see how that affects the tax bill for the estate going forward. Yeah. It's a federal thing. Yeah.
Get a step down, please.
No, I don't think so.
You inherit it, then it drops, or
But why would you want that?
I don't know.
Because then if it goes back up, then you're kind of screwed on the tax bill.
Well, I've had some people inherit things, and by the time they wanted to sell and pay out the house or something, they'd gone up in value. So they would have used that 6 month thing.
Yeah, hopefully. Yes.
It's not renting properties, but.
Mhm. Yeah.
But, so I'm gonna sell my house this summer, and I've been there 8 years.
Okay.
And prior to that, it was rental property for 5 years, prior to that. So I've been in it 8 years now, but those 5 years where it was rental property, there was, I guess, depreciation.
Gotcha. Yeah. Mhm.
So what is my tax liability on that?
So it'll be hard to say without looking at the specific situation, but you're going to be dealing with something that's called depreciation recapture. So basically, you got to depreciate that all the way down. And from the original basis down to where you are now, the amount that you depreciated, that's going to be taxed at a certain rate. There's a couple different options for that. And forgive me, I forget what they all are. I only remember one of them. But there's a couple different, depending on the depreciation schedule and what type of asset and all that kind of stuff, there will be a certain tax rate that you pay to recapture the depreciation you took. Then it will be capital gains on the rest up to the fair market value. Yeah. Yeah. So, okay, so basically, let's see if I can do this. You buy your asset at this price here, and then because you're depreciating it, you're walking it all the way down to here, and you're writing off all these losses in the meantime. So you're writing off the depreciation, and you went from this value up here to this value here, but you're going to sell at this value here. So the IRS wants you to make up for all of that cost that you wrote off, so they're going to charge you taxes on this, which is the depreciation recapture. The period in between from when you originally bought it to here, they're going to charge you a certain tax rate to recapture that depreciation that you took. Then the rest from here is going to be probably your long-term capital gains rate, which is your preferential tax rate. Yeah, it depends. I forget what the exact rates are because there's like 1245 and 1250. It's all mushed in my head. I know that is the rate for one of them. I just don't remember which one it is. Yeah. Well, I mean for which section, like section 1245, 1250. There's a bunch of different ones that I don't remember. Yeah. Anyway, this is the depreciation recapture that you're definitely gonna have to pay. Yes.
That's because her property was a rental.
Yeah, so because it was a rental, she was able to take depreciation, which is a deduction that you get to take for a lot of different reasons, but it's essentially just saying like this, because it's an asset, it's getting used and all this other stuff, there's a certain schedule that you get to follow and write off a certain amount of loss every year. And so because she wrote that off on the way down, now we have to make up for that in the current tax year since we're selling it. So if you hadn't done that, that's not going to be part of your personal residence for the most part. Yeah. I think of course there's a chance, but when we're talking about real estate stuff like this, I kind of doubt it, at least in the negative. I kind of doubt that they would make a change like this that is worse for. Exactly. So it's like that bias is probably going to play to it. Now, it's hard for me to say any sort of prediction on what's going to happen, but yeah, Yeah, so when it comes to that, there's a lot of things where the longer a policy or exception or exclusion or that, the longer it's been around, the more confident I am it's going to stick. Because oftentimes you'll see things like I forget any specific examples, but if there's like some little trick that somebody figures out and the IRS doesn't do anything about it for like 3 years, but people weren't doing it beforehand, there's a decent likelihood they're going to come in and squish that back down, or whoever's in charge is going to make sure that that goes away so that things go back to the way they were supposed to be. So a lot of these things that just have been around for a really long time, really because of how much unwinding and how much that would really cause a mess, particularly like in stuff in the real estate market. Yeah, but you know, it's such a, and more of a mess for capitalism, you know, where it's less about like the democracy and all the political stuff, but more about the actual money system, which obviously we know that's always the game. So that's what I would always be focused on. So now moving on from the real estate portion, we'll talk about things like so we'll just do kind of an overview on what we talked about. last time and the early parts of today. So we just pretty much did an overview of cash flow planning, insurance planning, all of this stuff that you see on here. We haven't really dived into investing yet, but we'll get started with that today, and we'll see how much of it I can get through before we get to time. But what we really want to emphasize is to make sure that we pass on this knowledge that we're getting here. That's one thing that my generation struggles a lot with, is knowledge in this, because they feel, for whatever reason, a lot of people feel cheated out of a good system. A lot of people didn't really get the proper education as we were going up. I mean, I know that all of my education for this didn't come at all from school. Yeah, and it's just like we kind of get thrown into the system and get to figure it out ourselves. And the thing that's really frustrating about that is that would be fine if things were just so much simpler, but they're not. They're really complicated. Now, the stuff that works is actually pretty simple for the most part, but there's all this other stuff that everybody attaches on. People love to sell things, obviously. It's the business of money. People are going to be trying to sell stuff left, right, and center. But it's just really important to share some of this knowledge that you get here, or any things that are clarified, to pass that on to younger generations as well. I mean, just simple things like making sure you have a cash reserve, maximizing insurance when you can afford it, because those low frequency, high severity risks can be really bad. Investing in liquid and tax favored reserves, and just making sure that you've got things to pull from. Maximizing Roth contributions at a young age, really, really important. Because again, if we think about compound growth with a Roth IRA, Roth 401k, if you're putting Roth money in at a young age, at a low tax bracket, with minimal impact to the contributions, and you're putting that in there, and then you're investing in these long-term growth stocks or growth equities or whatever it is that you invest in for long-term growth, and then you get to the end of retirement, and you get to take all that out tax-free, instead of being in a situation with RMDs where, you know, you got to pay your federal taxes and your state taxes for every year, but you just get to a point where your whole retirement is funded with tax-free dollars. The compound math on that gets pretty strong. And then obviously stuff like a will. Just getting a will set up for a younger generation person is really important. So make sure that whoever you're talking to, make sure they got this stuff set up. Couple other examples of pieces of knowledge to share, stuff about like a trust, which circumstances it's important for, durable power of attorney, so that if something happens, they're able to take care of that, document storage and cybersecurity, something I hope the younger generations are better about, but it's really important to have strong protection and storage for all of your digital needs as well. Very much recommend something like a password manager, so you can start randomizing passwords instead of using the same password across 50 different websites. So things like NordVPN has or NordPass. Dashlane is what we use in our office. I know Norton has one along with their antivirus software. Definitely recommend using a password storing app. So with that, let's go to today's slide deck. Give me just a second to pull that up. And we can dive into a couple concepts that are a little bit more investing related. All right, here we go. So let's we don't need to do the recap because we just talked about all that. Okay, we're going to start talking about types of accounts. I mean, for the most part, I kind of center, whenever I think about these, I center around investment accounts. So that's kind of my frame of reference, but there are other accounts like checking accounts that these things can apply to as well. So we've got two main types of accounts when we're looking at investments or whatnot. So we've got tax-advantaged accounts and we've got non-tax-advantaged accounts. Tax-advantaged accounts you'll be familiar with. They're just accounts that provide some sort of tax benefit. So we'll have tax-deferred accounts like a traditional IRA. You put your capital in there, pay no taxes today, and you pay taxes when you take it out later. Same thing with traditional qualified plans like 401ks, 403bs, et cetera, et cetera. Next, you'll have tax-exempt accounts. And these are ones where usually for these Roth accounts, you'll put taxed money in, so money you've already paid taxes on, no current deduction, but you get no taxes on the way out. Amazing for growth opportunities. You've got Roth qualified plans as well, same thing, Roth 401ks, Roth 403bs, like we talked about a little bit earlier. And then you've got something like a 529 plan, which is also really nice because you get a fantastic tax deduction when you spend it on things that are qualified expenses. So it's kind of like you have that, and as well as HSAs and whatnot. It's those accounts where you get to put capital in there. It's not for retirement, but if you spend it on qualified expenses like education or medical expenses, then you get to not pay any taxes on the money as it comes out. Everything else is just accounts where you make contributions with after-tax dollars and earnings are taxed in the year in which they're received, or they're deferred until or when you take them out as well. So we've got a couple different account types for your non-tax advantaged accounts here: your individual, joint, community property, trust and estate accounts, custodial accounts, business and entity accounts, just sort of your standard, like right within my grasp sort of accounts. There's no nothing you have to do to get it out of there. Yes.
I set up my trust last year, so my current house is in the trust.
Mhm.
I need to sell my house, so no longer have a house. How do I get that out of my trust?
So what do you want to get out of your trust, and what kind of trust is it? Okay, sure. No, you can just sell the house as it's in the trust. That's okay.
Brought that up last week.
Yes, yeah, we did. Yeah, so you don't need to retitle it or anything. Yep.
Don't have to bother with the other one.
No, not really. Yeah. Yeah, especially if it's something like a revocable trust where it's still your social security number anyway, so it's all just kind of tied to the same thing. So now let's talk about a couple plan types. Now, I want to say that qualified plans are not the same as qualified accounts. So if you hear the term qualified accounts, that's really not, it's not like a technical term. It's something that some people have adopted mostly for the idea of including things like IRAs in the same conversation as a 401k. So somebody says, I've got a qualified account, and they're talking about an IRA. What they're not talking about is a qualified plan. So a qualified plan is a retirement plan that qualifies under Section 401A to comply with ERISA. So that's how we know we can differentiate. That's why an IRA is not included as a qualified plan, because it's not protected by ERISA. It's not an ERISA qualifying plan. Only retirement plans under Section 401A get to qualify as a qualified plan. So this will be a traditional and a Roth 401k. You'll notice the similarity: 401, 401. And you'll have traditional and Roth 403bs, SEP and simple IRAs, which are a specific kind of IRA, traditional and Roth 457bs, TO plans, and employee stock ownership plans. So all of these are qualified under Section 401A, which means that they get protections from the Employee Retirement Income Security Act, things like creditor protection and a lot of fiduciary responsibilities. Yes.
Not protected.
Correct. So it's not a qualified plan, so it's not protected under ERISA specifically. So that's why we talked about before, we have to talk about state protections, because California, if you roll an ERISA plan into its own IRA, they extend the ERISA protections themselves. ERISA doesn't protect it, but the California courts will. So they'll rule in favor of you in whatever circumstance that is. Right, that's why, yeah. But yes. So essentially, a lot of it is that creditor protection. So if you're in a qualified retirement plan and somebody sues you, they can't go after that because that was a plan created by your employer for your retirement specifically. And we want to protect that income stream later on.
Change the name of ERISA to O.J. Simpson. He got away with that because he had ERISA protection. He kept his football pension plan, and although one side was suing him for a lot of money, they couldn't touch it. So he was golfing every day and living off his pension, which was protected under ERISA.
And so that basically protects murderers.
It did, yeah. Yeah.
Yeah.
Every time I transferred my 401k,
Mhm.
401k to a traditional IRA.
Yeah, so, well, it could be. It could be. So here's the thing. When you've got a traditional IRA, it's kind of protected. It's not all the way protected like an ERISA plan is. A traditional IRA, usually the first million will be covered for the most part. But what can happen is the courts can look at the account and go, how much of this do you need for your retirement? And they'll determine that for you. They'll go, you need this much, therefore this amount is protected, but we can take the rest. And so when you push together a qualified plan and a traditional IRA, it kind of muddies the waters. So now they need to be able to differentiate which dollars are for which earnings are attributable to which principal, and it just kind of gets a little messy. So that's why we really like to keep it separate in California specifically, because of those protections that are offered for a rollover IRA. We want to make sure we keep that separate so we can go, look, that's my rollover. Don't touch that. That's my rollover. California will stand behind me on this. And then traditional IRA gets the traditional IRA protections, which usually covers the first million, but can be up in the air.
I should keep track of who's rolling.
It would be a good idea to know exactly how much was rolled over and have proof of that transaction so that in the horrible event that something happens, you can go, listen, this came from my ERISA plan. Give me grace for this because that should be protected under California law.
Find it with a little IRA on the side, or?
Yeah, well, I did. I created an IRA for my brokerage firm.
Okay.
And I told my employer, I want to roll this 401k into this IRA.
Okay.
And he did. Now I gotta go back to my employer and find out how much they're gonna roll over.
Right.
Yeah.
Right, because if you were sued and they're trying to get that away from you, you'd go to court like Nash said, and the judge would say, no, he rolled this in, we're gonna protect this now. We just try not to combine them all.
Yeah.
But Nash is right on.
So I need to figure out how
Yeah.
much.
Yeah, I would highly recommend figure out what that rollover amount was and then, just keep that on deck just in case. Yeah.
That way, you don't include this in your numbers calculation for umbrella insurance. I don't have to worry about that.
Exactly, because it's covered. And same thing for the rollover IRA, because California would step in and cover us, then that's why we also wouldn't include that in the calculation. Yes, exactly. Okay, non-qualified plans are basically the rest of the retirement plans. So we're talking about stuff that doesn't qualify under Section 401A, doesn't get same tax benefits. So we're talking about deferred comp plans, split dollar life insurance, executive bonus plans, group carve-out plans. All of these, by the way, are just fancy names for life insurance plans that are specific to executives and stuff like that. Yes, you got a question?
Like simple IRAs.
Oh yeah, the SEP and simple IRAs, I don't really remember much about them.
The SEP is self-employment pension.
Right. Yep.
Yeah, and simple is kind of like an easy way to do like a yearly days of a 401k for a self-employed person.
Yeah, before you had like solo 401ks and stuff like that, yeah. Yeah, the Keogh plan, yeah.
Senator Keogh. That was a plan that those of us that were in business, we didn't have a 401k or deferred comp. So I could put money into a Keogh plan and get a deduction.
Got it.
Yeah, so it's just kind of like it's kind of a version of a profit sharing plan, just kind of generally profit sharing plan. That this is like a split off. Yeah, right, exactly. Yeah, that just doesn't fall into 401k or any of the standard sort of vehicles.
Not qualified. Should I say it's for executives?
Well, these life insurance plans are, but sometimes you can have something like a deferred compensation plan. So if it's one that, so a traditional deferred compensation plan is kind of what you can think of your 401k, because you're deferring the money into the 401k. But these deferred comp plans for the non-qualified don't get a tax deduction. So it's still taxable, even though you're deferring it. And so it's just a little bit different. It doesn't get the same tax benefits. So that's something you'd probably be aware of. Yeah, I would be fairly confident that you don't, but just take a look just in case. Okay, so now we're just going to talk about a couple popular investment vehicles and just get all the jargon out of the way. So hopefully we're on the same page moving forward. Obviously, we've got stocks. I imagine that you're pretty familiar with what those are. Ownership of a piece of a company, and you might be entitled to a share of earnings, which are represented by dividends. One thing about dividends, I've been researching recently to try and make better our taxable account portfolios, is dividends can actually qualify for preferential tax rates, which is called qualified dividend income. So if you are holding a stock or a fund or something and it pays out dividends that it receives from dividends from the stocks or whatever, if you're getting dividends and you've held the asset for, I think it was 60 days or something like that, you actually get to pay capital gains rates on those dividends instead of ordinary income. So that would be another reason to use something like dividend paying stocks if you need some income, because you might get preferential tax rates just like you would on capital gains. Next, we've got our bonds, which is really just ownership of a debt to a company. So if you've got a company like Walmart says, I need $1,000 and I'll pay you 5% a year for lending it to me. You give them that $1,000, they give you 5% until the maturity date of the bond, at which case they will give you the money back. So the purchaser provides the capital and receives interest as compensation, as well as the initial principal at the end of the term, which is what we call the maturity date. Now there's another type of bond called an original issue discount or zero coupon bond. So we'll be talking about T-bills a lot. Those are zero coupon bonds, which basically means coupon is another name for interest rate. But it's like the original interest rate when it's issued. So if I issue a bond at 5%, that's the coupon. But maybe later it's worth more. So now when you spend your money, you're only getting 3% back. The coupon is still 5, even if the yield is lower at something like 3. But a zero coupon bond essentially means there is no coupon. You're not getting any interest, but you're paying less for the money. And then when maturity comes around, you get more money back. So it's basically just saying, I'll give you $700 now. And when this bond matures, you're going to give me $1,000 back. So that's where you're getting the interest. And you actually have to pay for that increase a little bit every year as time goes on. And that's called imputed interest. That's a fun thing. So that's what T-bills are. The longer term treasury bonds will just pay you interest. But if you buy a T-bill, which is 52 weeks or less in maturity, you'll buy it at a discount, and then you'll receive back more money at the end of the term. Next, we've got our mutual funds and exchange traded funds that we've talked a little bit about. In a super quick summary format, it's a basket of securities that are either actively or passively managed. Somebody else is managing the bucket of securities, keeping it all together, and you're just buying a piece of that pie. It could be stocks, bonds, or derivatives like futures and options, or alternatives like real estate, commodities, and pretty much anything else you can imagine. Soon, maybe it'll be crypto too. Who knows? All sorts of different things can be within mutual funds and exchange traded funds. And there actually are some ETFs and mutual funds coming out these days that give access to products that you don't actually have access to on your own, like private credit or sometimes even hedge funds. So those are starting to be ways that those products become more accessible to the rest of us. Next, we'll have a fixed annuity. It's basically a type of insurance contract where the issuer promises to pay a certain amount of interest rate on the money you contribute to the account over a specific period of time. And then you get to annuitize the contract, which basically means all the money that's built up in there, you get to say, all right, calculate my lifetime and pay me a steady stream of income until I die. And they'll split the amount up. And if you live too long, that's when you get to stick it to the man and actually charge them more money than you gave them. But if you die in a shorter period of time, they'll pocket all the money and use that to pay for the rest of the policies. This can be funded either with a lump sum, so that'll be something what's called a single premium immediate annuity, or SPIA. Will basically be, I'm going to throw in $100,000 now, shoot me an income stream for the rest of my life, and that's a single premium immediate annuity because it's one premium going in and it's immediately annuitized. Yes. Sure.
If I die now, there's still plenty of principal there that will.
Yeah, so there's a couple different types of annuities. There's a lot of different things. You can have some annuities that have death benefits. You can have annuities that have cash value that can be paid out. So there's a lot of different, like you got your variable annuities, fixed annuities. There's a lot of different stuff. But yeah, there's a lot of different versions of these contracts that can exist out there.
Take a life, say I'm worried I'm not gonna have enough money. Here you can have all my money and pay me like 70% of the principal for the rest of my life. But pay me the principal and interest. if I die within, say, 10 years, they'll keep paying that to a family member. Or longer, depending on what they feel like.
Yeah, so that would be called a period certain. So if you've got something like a 10-year period certain, if it pays out for 3 years and then you die, we're saying, we locked that in for 10 years, so now pay out the rest of it either to the estate or whatever. Exactly. So you've also got, oh, yes.
Makes such sentiment with a movie, and then when you pass away, they take the problem. Right?
Well, that's reverse money.
Yeah. reverse-
Oh, yeah. Well, we recommend only at last resort type thing. If you aren't willing to move out of the house, you're just building debt on the house. And you get to live there for as long as you live. Then when you die, they're gonna make somebody sell it, paying back principal plus interest. So I would use it as a last ditch effort. It's not a good financial move for beneficiaries, but if you don't worry about them and you want to stay in the same property. But usually it's better to sell, buy a small condo and pay that off and have extra money. But if you aren't willing to move out of the house, a reverse mortgage is an option. But usually it's not a great option.
It's the last resort.
Last resort, yeah. I mean, if you have no beneficiaries and you have too many memories, I'm not moving out. Maybe you let a caretaker stay in one room. I have a client doing that, and I'm recommending do a reverse mortgage because he's not willing to leave the house at all. So at least he can either get a checkbook and write a check each month until he hits his limit, or pay off any mortgage if you have one, or get a lump sum of money. But you're paying the devil if you want your beneficiaries to get something. So if you have beneficiaries, you tell them, I'm thinking about a reverse mortgage. No, you eat up my equity. Okay, well, then why don't you start paying? Right? So it's last ditch effort, but.
Yep.
Get Tom selling to selling it.
Yeah.
Yeah.
The good thing, government's very strict with them. You have to take classes and they have rules on how much commission and fees they can charge you. So I told my client, go to the credit union and just talk to them because you want deep pockets. If they mess with it, you want somebody to sue. And then watch a bunch of videos back and forth on this stuff. But same thing with the annuities. The concept is good, but when you put commissions and fees and all that stuff, then they ruin it.
There's a large down cost to it.
Yes, upfront, reverse mortgage can be 10, 15,000. Yeah, and they add that to what you owe. So only a last ditch effort.
Yep. So another type of annuity that we've got is an indexed annuity. So this will be similar to a fixed annuity, but the interest that you're getting on your contributions varies based on the performance of an index. Now they get away with this and it's still considered an insurance contract. It's not an investment because technically they're still just giving you interest. You're not actually investing in any stocks or bonds or anything. They're just looking at a different index, which by the way, they're taking all your money and investing in, and then they give you a portion of the returns. And maybe they say, if it goes negative, we'll just give you nothing. And that's totally fine. But then you do the long-term math and you realize they're compounding that money over time and just absolutely hosing you in the process. But basically, what's happening is they'll be looking at an index, and if an index does super well, 10%, they might give you 7% interest and credit that to your account instead of the full 10. But like I just said, it's limited usually by caps set by the insurance companies. So you'll get both a participation rate and a rate cap. If you're super unlucky, you get both at the same time, where you might have a total upper limit cap at the interest that you can get. So maybe you're only allowed to get 7%. The index could go up by 35. It doesn't matter for you, you still get the 7. And they might also say, well, but you only get to participate in 70% of that. So if it goes up by 10%, you only get credited 77% anyway, even if your cap was higher. So really, if you're looking at these products or you have these products, understand them and read every detail of this. It's really important to understand how these work because this is where we get to products that are not considered securities, but they act really similarly to securities, just with a lot more fees and all of these other things sort of baked in. So it's really important to pay attention to that when you're looking at annuity policies.
Yeah, sure. I would not recommend it.
It's not great.
There's internal costs. I just looked at, a friend of mine insists on wants an annuity. We're trying to talk him out of it. So I went to the company and said, "Okay, show me the yields." Well, the annuity that he would get from a broker is 4.5% yield. But if you got a no-load annuity, it was 5+.
Is
So,
that guaranteed?
whatever time frame we're saying, but the point is that if you buy an annuity where somebody makes 5%, if I sell you an annuity and they pay me 5%, my boss gets another 2%, and the home office gets another 2%. So the company has to make that up. So they say, you don't pay the commission, the company does, but they're gonna squeeze out your return over time and give you less.
They're so complicated. Why
Yeah.
would anybody get one?
We talked into it, it sounds good to me. Yeah, true. The other thing is, if you trust an insurance company to guarantee this payment, even if it's really good, what if they go up? They read the disclosures, that's all you have to do.
Yes, sure, but
Yeah.
does that have any weight anymore?
So I could,
Nobody should get it.
No,
The only annuity that we think is legitimate is Social Security, and even it has problems.
Social Security
Well-
is not a choice.
Not a choice, and, but they're taking money from dead people and helping people that are alive. That's the objective, so if you haven't lived too long, you win, if you die early, you leave the money in the pool. These annuities there are for companies to manage your money and give you the best return you think you're gonna get, give you guarantees that they may or may not be able to get. Because you're leaving all your money with an insurance company, and if they manage it wrong and the market crashes, they could lose everything you've got. Hartford dropped 90% stock value, but they had a bunch of annuities that they had to care for in 2008, so that's a scary thought. So we're not.
No reason, we don't push annuities.
No,
We
no,
don't encourage annuities, either kind, the index.
no, an immediate annuity maybe, but we don't do those.
I got into it, I didn't mean like 5 years ago. I didn't realize it's a mistake, but it feels like I've been paying for it like 5 years, and if I pull out, it's like,
yeah,
I'm losing all that money.
yeah, of course. Yeah, and I'll tell you exactly why people buy annuities is because they're scared. Right now, I guarantee you, thousands and thousands of annuities are being sold all the time. And you want to know why? Is because they think the administration is going to crumble the economy and these guarantees are going to keep them safe. But realistically, over the long term, they get hosed. They lose everything. I mean, they can get their little guaranteed payment, and that can be nice. And then you look at the math over the long term, and they go, well, if I had just stayed following the other simple plans that everybody else lays out, I would have been actually better. Yeah, and it's just like you know, all these guarantees sound great, but why do you think they can offer them? Why do you think that they can offer these guarantees?
One FDIC
Well, who's, is the annuity saying they're FDIC insured, or did you buy it from a bank? Okay.
Yes.
By the way, this new administration is doing away with FDIC.
Well, they do.
That's true, because everybody's money is in a bank that's FDIC insured, and money market, that's in an index fund, everything's FDIC.
Even if they
Well-
did, though, you went and bought treasury bills and other safe items, because our frustration with banks is, everybody thinks the banks are so great, they just put all their money in there. Banks are known to crash, like we saw with the crypto stuff, right? The banks are given too much leeway. If they did get rid of FDIC, then you have to look at the real health of the bank. Then we would say treasurydirect.org, buy T-bills for a broker.
Yeah. What I will say also is securities are not FDIC insured. So index funds and whatnot, those are not in there. Brokerage accounts, only the money markets are considered FDIC insured. That's it. And even then, kind of depends. But when we're talking about index funds and mutual funds and stocks, those are covered by something else called SIPC insurance, which is a different arm of the government. Yeah.
If the whole economy crashes really bad, the insurance company is gonna go down because they have all their assets in the things they're investing in, preferred stock, blue chips, real estate. That's where your money goes. You just don't get the growth of those things.
So where is this, I mean, really, the bank?
Yeah.
So much stuff with there, you really keep paying.
So what you'll want to do is you'll want to take a look and look at the surrender charges that are applicable to you. So there's going to be a schedule. When you first buy the annuity, that's when it's the worst, because if you surrender it, you get like half your money or sometimes worse than that. But usually the percentage will go down slightly over time, and usually within, I mean, depending on what the schedule is, but oftentimes I see that the drop off happens at about 10 years, and that's when you can pretty much get everything back. But you might be at a position where you go, I'm willing to eat this little surrender loss, take it and do something else, just to kind of clear the pain. So I would look at your surrender charge schedule. That should be somewhere, that should be very easy to find, and then you can determine whether it's time to pull out of that or not.
So,
Right. Yeah. Yeah, and that'll basically be kind of your best option is if you're still deep into the surrender period. Oh, okay. Yeah. Okay. Yeah. So, yeah.
you could annuitize it, your money's based in. It's.
Yeah, I think that's what she said. She did.
But you don't have to worry about that going over the get a fixed dollar.
Right, but
Yeah.
if we're talking about the gateway with FDIC, then how do I know?
Well, most annuities are, you'll see the bottom of the disclosure said this is as good as the assets from the insurance companies.
Yeah. So oftentimes, I mean, because these industries are so large, oftentimes like this isn't a recommendation of safety when it comes to insurance companies because they can go down all the time, but oftentimes they scoop each other up. So like like what happened back in 2008 and in these horrible real estate or in these horrible markets, some of the insurance companies went under and then got purchased by another bigger insurance companies, and they continued the contracts. Sometimes it was at the full value of everything, sometimes a little bit less, but they would pick up and continue paying out those contracts a lot of the time. So while there's no guarantee that that would happen, that's a lot of times what happens in the marketplace, because whether it's via the government infusing the market with a lot of capital to make sure things don't just completely fall to the ground, or it's the insurance companies going around and scooping up failing businesses, because in the long run it'll be profitable for them anyway. The current ones just got over leveraged and
Safe investment, right? So if you have treasury bill, short-term equity, maybe the long-term, if you have AAA rated corporate bond, they're not so far in debt that whatever everybody else does, they don't get hurt that. We saw that 2008 when the government was worried about making it and the banks were worried about crashing. But the AAA rated bonds we had didn't drop much because they were high quality or the trade. Or the blue chip stocks where they don't leverage and they're not in and those things. So you can do investment portfolios that I can't say are absolutely guaranteed, but when we saw 2008 crash, I felt a lot safer in stocks and bonds because they were not leveraged like the government. That's a big concern. Yes, and that's another downside. You don't get a stepped up basis. So there's very few times that we would ever recommend an annuity like reverse mortgage. An immediate annuity, if I, this is all I got here, take care of me, but even then you want 2 or 3, because if one company fails, you don't want to have all your eggs in that basket. Remember GM bonds, they failed in 2000. And some insurance companies had to be bought out by others.
yeah. So
well, if it was an IRA, it might have an annuity in it. And if it does have an annuity in it, if somehow that annuity says we're insured by FDIC, then I have new worries about that kind of stuff. But you could move money around into T-bills.
yeah. So again, the only place I'm looking to use annuities is either, for some people, they like using them instead of long-term bonds because, you don't get the same volatility and you get this payment but it's like if you can slot it into an investment portfolio like that, it can be helpful. But really the main time that I'm looking at it as a recommendation is if we've exhausted all other tax deferred investments, all other places where I want to get deferred growth, maybe I could put it in there. But at the same time, I could buy growth ETFs in an individual brokerage account and effectively have kind of the same thing with even better tax rates coming out anyway. So it's a hard product to recommend. Lastly on that, we've got variable annuities, which is basically the same thing we've been talking about, but there are sub-accounts inside it in which you actually invest in the market. Now remember, you still have to pay insurance premiums for the contract. Then you also get to invest in here. Earnings accumulate tax deferred. Yeah, so it's just kind of like investments and that insurance product packaged together. Then we've got some of our non-publicly traded investments, limited partnerships, non-public real estate investment trusts, though there are also public real estate investment trusts, so I don't want to confuse that. Private equity, private credit, just stuff that you're not really going to be having access to or that we recommend you put in a portfolio. Internally, mutual funds and ETFs can use a lot of different assets in order to create a particular portfolio for the customers. So the selection of assets is determined by the strategy of the fund or by the manager. So again, if we're looking at something like an S&P 500 index fund, the strategy of that fund is to buy the securities that are in the S&P 500 and weight them similarly. So then we're just going to have a fund that has stocks from the S&P. Yes. Sure.
Popular investment vehicle. So I got stocks, bonds, mutual funds, and ETFs, and then the 3 kinds of annuities.
Yeah.
And now we're going on to another subject. Is that right?
Yes, correct. So we're talking about things. Which part? Right. So we're looking at mutual funds and ETFs and what are inside of them.
Oh,
So we're just kind of, yeah, a little bit.
funds and
Yeah.
ETFs.
Yes, exactly. So we're just looking at within mutual funds and ETFs, you can have a lot of things inside of them to follow whatever strategy or portfolio we're looking for. So we can have all different types of stuff. We could be having a fund that just invests in limited term bonds, so shorter maturities. We could have a fund that's just looking for capital appreciation, which is just growing the money. We could have a fund that's trying to have a moderate allocation. So if we're looking for kind of a 50-50 balance of stocks and bonds, there are some funds that do that for you. Derivative income. So there are some fancy strategies that can shoot off extra income in some different ways that we can get more into later when we talk about specific assets. Income from mortgages, all sorts of different things. So all these funds just try and do something in the marketplace, package it up as one product to sell to you so that instead of you having to go generate income or you having to go buy every single bond, they just do all that work for you and you buy the one share. So there's a couple different internal assets that we can be looking at. We've got cash and cash equivalents. So it's pretty much exactly what it sounds like. Assets that can be converted to cash immediately with little to no variance of value. So we're talking about bank savings, certificates of deposits, U.S. Treasury bills, corporate commercial paper, which is super short-term corporate debt, and other money market instruments like that. So this is usually what we're using as sort of a balance in the middle. Yeah.
I have a question on Zoom. It says, do you have any legit websites where we can check bank ratings, thinking of CD investments, stocks, bonds, and want to make sure the banks are solid? And there seems to be a lot of contrasting information out there.
Right. So a lot of the times what you'll want to do for credit ratings is you'll want to look at places like Standard & Poor's, Moody's, I forget what the other names are. There's like 1 or 2 other ones that I can't remember, but yeah. Yeah, for the credit ratings of those banks. Okay, so yeah, so those are your big rating agencies like Standard & Poor's and Moody's. They'll have credit ratings on each different company and corporation. They'll let you know basically from AAA down to D. We'll get into those specifics later, but that's where you can go to check the credit rating of those different companies. Let's just try and get through some of the internal fund assets here before I let you go. Next, obviously, we've got our bonds like we talked about before, but we've got a bunch of different kinds of bonds that we could be investing in. We know that this our type of debt and what we consider to be fixed income because it's a certain amount of income per period. But we've got a bunch of different types of bonds. We've got bonds that are fully taxable. So think of like a regular corporate bond. You loan the company money, they pay you interest, it's taxable, normal thing. We've got tax-free, which usually is municipal bonds. So if you buy a municipal bond in your state, you won't be federally taxed on it, nor will you be state taxed on it. So that again is sort of it's the credit rating of the state that you're worried about or the particular project because there's different types. But municipal bonds will usually be the thing to provide you totally tax-free income in your investment portfolio. Then we've got, this is kind of harkening back to that credit rating conversation. we've got both what are considered investment grade and junk bonds. We'll talk about the specifics of that later, but essentially investment grade means good enough to be considered a solid investment, and that's from a certain credit rating up. And then below that credit rating is considered junk bonds, or if you want to be a little bit more generous to them, high yield. So that's kind of what that is. And then we've also got government bonds, which will be our municipal. So again, that will be the S&P and Moody's. Those are the rating agencies that will give you a rating. But you can look at a service like Morningstar, and they will give you, if you're looking at a fund or a specific bond, they'll give you the credit rating within their analysis. So we use Morningstar all the time. That's a great software for stuff like that. Okay, so do I have stocks? Okay, I think I have stocks in here twice, but there's some more specifics in here that I can talk about anyway. So we've got a bunch of different types of stocks as well. Most commonly, we're familiar with US equities, which just means United States companies. And then we've got our foreign developed and emerging markets. So we've got countries that are sort of kind of on our level in Europe and whatnot, sort of the developed, strong countries. Then we've got emerging markets, which are the smaller markets that are trying to make their way into being developed. And then we've got also some categories like small, mid, and large cap, which is referring to the market capitalization of a company, which basically just means how big is it? When you hear something like Apple being $1 trillion company, this is what they're referring to. So there will be certain numbers, and basically large cap is anything, I think it's $10 billion in market cap and above. So think of your blue chip stocks, S&P 500 companies, stuff like that's going to be large cap. Then your more developing companies will be the small and mids. Then we can also split stocks into two categories of growth and value. Like I talked about before, when you're thinking of a growth stock, you're thinking of a company that's hoping to increase their market share. How much of the market are we picking up? Versus a value is like analysts are thinking that it's less expensive relative to its maybe its dividend or its different fundamental factors like price to earnings ratio. But a lot of the times when you're thinking growth, you want to see the stock appreciate in value versus in value, you're looking for the stock to be giving you dividend income steadily over time because they're already profitable. And then you can also have something like alternatives. So like I talked about before, real estate, commodities, derivatives, hedge funds, managed futures, and even art and antiques, a lot of different stuff that can all be packaged up into this one asset and sold. And usually we don't use this for a big portion of the portfolio, but if you like to have a little bit of fun, you can sprinkle it in there in small amounts. So with that, we're a few minutes past our time, but that basically covers all the internal assets. So before we go, do we got any questions on all that we just went very quickly through? All right, cool. Well, with that, brings us to our time, and we will again have a bunch of slides from today to go over next week. But I love the discussion. I love talking to you guys about all this and making sure that we clear everything up. So please, always feel free to answer questions, and thank you for coming. Next week, we'll continue this conversation, but the other thing that we'll be talking about is, we'll get into the beginning of the investment process and building a portfolio and the methodologies that we use.